Let's take it across to Mahantesh. Mahantesh, do you have an answer for this? Which are the stocks you are taking off the portfolio from the real estate pack booking profits?
Generally speaking, the entire real estate pack is actually doing really well. This is because the overall housing demand has turned around quite strongly. Unsold stock, which used to be pretty large, nearing about 3 years to 4 years, a couple of years ago, is now down to 2 years, almost half that level. And therefore, the real estate sector is growing quite sharply well. It's very difficult to really pick. So if one were to readjust the portfolio, then one would only do a very simple arithmetic. The top performing is something which will go a little underweight, and the most underperforming is what you'll go a little overweight on. That's the only churn that you will do in the real estate pack per se. But then the other metric one could really look at when it comes to real estate sector, go for those which have really no debt on their book or have a asset light real estate model.
Right. Okay. Just looking at the market texture right now, it's Indus Towers 8% higher. Idea, even though it's come off a little bit from the day's high, still holding up well. Um, Maybe Macrotech, or for that matter, Keystone Realtors may not be holding out, but Godrej Properties sure is. It's sitting at the high point of the day. It's a 3% spike that the stock is currently seeing in trade. Bring up that stock price up for you. And then, of course, Indian Hotels as well. And I think it's already scaling at its life highs or around that mark. 594 is where Indian Hotels is. And I think the entire hospitality sector as well holding out still pretty okay in trade. Mantesh, still got valuation comfort in these hotel names?
More than the hotel names, actually, a sector which is very similar to the hotel space, but slightly different in terms of their business model is hospitality. Sorry, is hospitals. And hospital is a sector which has suddenly emerged into the market as well. Years ago, you didn't really have a choice of hospitals to choose from. Now you have a array of hospitals with recent new listings, right from KIMS, Kowai to the older names, which is Apollo Hospitals, obviously. But I'm saying that when you really talk about that space, hospitals is more uh, clearly better managed than relative to the hospitality space, because in India, tourism while is growing up, you still find that foreign tourist arrivals is a little muted. Airlines growth in terms of volumes are not yet clearly moved out of the COVID hangover, and therefore there could be a little stress on the hospitality sector.
That pressure or not, because for now most of these stocks including Indian Hotel, Chalet, Lemon Tree are sitting at record high levels. But Mahantesh, what's your view on a couple of these names which are the trader favorites right now? Fundamentals might not be backing it. Geo Financial Services and Vodafone. A value buy or a value trap?
Let's look at it from the business perspective. Okay, from a business perspective, Geo Financial Services is a stock which has growth ahead of it in terms of not just pure numbers, but even in terms of spaces that they can enter into. So Geo Financial Services can get into wide-ranging financial services, and there seems to be no limit in terms of the spaces available to them. It's only a matter of how well they will get capitalized, how fast they will grow the book. On the other hand, the idea which you talked about is a space from a business perspective is already a crowded space, already a space which has limited headroom for growth in terms of pure volumes. But the only silver lining for an idea kind of stock would be if the debt overhang somehow is resolved as we go forward, partly from an infusion of capital into it and partly from its own operations being better, then it could do start doing better. So purely from a business perspective, these are two different segments. These are two different outlooks, but both have a great future ahead if well managed. And therefore, I wouldn't call them value traps at this juncture.
Okay. Well, Enable's housing, the partly paid up shares for rights issue are going to be listing on Friday. That's what the BSE circular is saying. The stock is holding up 8% right now. And the partly paid up shares up 20% after the listing. That's that on that particular stock price. But some of these defense pack movers, they continue to hold higher. BEL being such case in point, that's looking good and continues to do so. Within the Nifty, of course, it's a much more quiet move today, while Bajaj Finance, DRL, Titan, M&M are still continuing to hold on. That's not quite the case with OMCs. In fact, I think for a third day in the running now, they're still in the red. There's SBI as well, which is down. ONGC has gone into a bit of a pause mode. Today, Maruti, IndusInd Bank also is lower for a second consecutive day. Yesterday also you had a sharp downtick on IndusInd, Bharti, ITC, Axis. These are all laggards in trade. Kunal, just a specific call on the way the private banking pack has been moving. Where do you see HDFC Bank going next? Now that it's crossed past that 1400 level, there's a lot of enthusiasm on it being the best buy on dips amidst the large caps right now. And then SBI and ICICI Bank on the other hand.
See, I think price-wise, of course, HDFC Bank could be a lot more lucrative in terms of risk-reward because the stock sub the 1400 levels last week or so, I think was at a very peak point in terms of the negative or pessimistic indicators for HDFC Bank. So what we've seen in the last 1 week approximately is almost like a 100-pointer relief rally for the stock price. But the only zing which is now going to be very, very important to watch out for is that whether short positions get rolled over for the March series, and that would be clearly seen in the next expiry. If that happens, then maybe this 100-pointer rally could be a short-term rally in the stock may continue to go into a drag mode. But if there are less amount of open interest which gets carried forward to the next series, that could be a very strong indication that maybe the entire negativity is actually out from HDFC Bank, and you could see the stock building on to this 100-point gain and slowly and gradually coming back above its 200-day moving average, which is closer to the 1500, 1550 mark. But on the other hand, I think the likes of ICICI Bank is now looking far more attractive, even though the momentum is a lot more staggered for ICICI Bank. But then when you try and compare the top 3-4 names in the private sector banking lot, Axis Bank, IndusInd, Kotak, ICICI Bank, and maybe add to that HDFC Bank, ICICI Bank stands much more stronger. It's confirmed a break of its previous swing highs about the 1050 mark just I think yesterday or day before. So I think that's the one which looks far more relatively far more attractive as compared to the other peers.
Okay, that's the take coming in on which way the banks are headed. Of course, next week you'll have the expiry as well. It's going to be that extended trading session. Remember, the DR side gets tested on Saturday. So March 2nd is going to be a trading day as well, just for a few hours or so. There'll be ICICI Bank board meeting as well. There'll be the VI board fundraising board meet as well that you'll have next week. So quite a few things slated in terms of queues up ahead. And then, of course, you'll have the monthly auto sales numbers as well in the 1st of March. Mahantesh, just wanted to get your sense in on whether or not you think, at least in the auto numbers, a rural recovery glimpse is going to show up, because it's been beleaguered for quite some time now.
Yes, it is indeed beleaguered for quite some time, and there seems to be no respite as of now. I think the respite for that will, on the rural side, will potentially come from any further reduction in interest rates. Okay, now that's not on the horizon, right, for RBI currently, simply because in the fight against inflation is not yet over. So having said that, the other mechanism through which the rural sales can potentially start doing better is if there is a better more monsoon forecast ahead. We typically watch out for the monsoon forecast announced on 1st of April, followed by the confirmation of that forecast closer to the end of May, when the onset really begins. So unless we see a better monsoon forecast of these two factors that I mentioned, which is the interest rate and monsoon, the only factor that can influence and make the rural sector do better for the auto companies is the monsoon factor. But it's an event to call for. You can't take a stance on it right now.
So that's the take as far as the auto sector is concerned. But Naresh, wanted to come to you and discuss some of these oil marketing companies. After that massive run up, they're also, coming off a bit. Which are the stocks which have reached the buying zone, if any?
So as of now, we've not reached that zone. Closer to 580, 590 is where you can look at a dip buy on BPCL. Hindustan Petroleum, again, it has to correct a little more for it to become a risk reward buy. So for now, I would wait it out maybe another 3-4% and then maybe start looking at it. I would need a correction of almost at least a 15% knock from the top to actually start looking at it. As of now, we've just corrected 6 to 9%.
Right. Okay, that's the take coming in on some of the OMCs. ONGC, also, by the way, that was pretty much in tow with the OMCs. Did see a hard run up, and I think for pretty much most of this week, it's been a little bit tempered. In trade 272 is where that stock is. The other pack which is seeing some serious profit taking is also the entire PSB pack. We've been identifying SBI here, but look at the rest of the pack as well. I mean, be it a Bank of India, Bank of Maharashtra, BOB, all of these stocks in sync are seeing quite a bit of weakness actually coming by. Knal, anything to worry here? Because it's pretty much in sync the way most of these PSBs have fallen today.
I think when you look at the PSU basket, most of the stocks in the PSU basket, whether it's railways, defense, power, etc., these stocks have had their share of 15% broad correction. I think some of them even corrected 30% or so in the last 1 month, 1 week of this price correction for the PSU basket. But I think the PSU banking stocks were moving on a stable upward trajectory. I would not expect a 15% kind of a correction into these spaces, but I would probably believe that maybe a 5% to 7% trim off from their swing highs, respective swing highs, could be a good enough correction for many of these stocks. So for example, SBI I think hit a level of 770, 775, which means maybe closer to 730, 735 could actually be a very good point where traders could look at a contra buy. For Bank of Baroda, around 275 was the previous swing high. So maybe I think closer to 250, 255, 260 could be a good level to go for a contra buy on Bank of Baroda as well. So not expecting a major correction, but just a minor 5% to 7% trim off from the previous swing highs.
Mahantesh, also wanted to get your sense on financials a little more, and I want to address the Goldman note this morning, wherein they have said that the Goldilocks period that the banking sector was seeing is behind us. There are multiple headwinds ahead, and that's the reason they have downgraded the likes of Yes Bank, they've downgraded SBI as well as ICICI Bank. So that's the interesting downgrade coming in, while they've upgraded Bajaj Finance. What's your view on the financials? Do you think there's a further derating which can happen? Or some of these names, specifically the likes of HDFC Bank, are within the buying zone?
Actually, I have a little contrarian view of all the sectors that you have. Actually, the financial services is far more stable relative to the other sector. The risks are now quite less. The reasons are like I can call out the reasons, three main reasons. One is they are well capitalized, unlike in the past where they would always struggle to raise capital or always on the brink of raising more capital at the cost of dilution. The second reason is they always struggled with quality in their portfolio, primarily in the form of either the NPA ratios being high or the provision coverage ratio being low. And the third reason they would struggle with was the expansion in business, which is credit growth, or it could be even expansion in margins, which is not necessarily linked to credit growth per se, but quite often linked to the underlying interest rates in the economy. Of all these three reasons, if you were to dispassionately evaluate, you will find that none of these reasons have really deteriorated for any downgrade to happen. You have stable names, you have credit growth, which is quite good. You have better capitalized banks, and asset quality is no longer a problem for many of these other banks. Similar is the case with many of the financial services companies as well. So having said that, the contrarian view to that comes to my mind is that it's one sector that can surprise you on the positive more than on the negative side. There are only smaller issues that they need to tackle. Smaller issues are such that their cost is actually going up. Both cost of operations is going up, as well as CASA ratio dipping is causing actually a overall NIM compression, not the underlying interest rate spreads. So to me, if you seek out good companies which have better grip on either the cost of operations or better grip on CASA, you can end up with a positive surprise for most of the banks and financial services.
Coming in from Westlife Food World on their entire cheese issue, saying that they are adhering to stringent food standards. Remember, the Maharashtra FDA had alleged that the cheese used in the Westlife products is subpar. So that's a clarification coming in. And the stock, of course, has been under pressure from the word go today. But speaking with ET now, the Railways and IT Minister Ashwini Vaishnaw today said that India's first bullet train project is progressing at a satisfactory pace. Here's his exclusive interaction with us.
Today I have inspected two sites. First is the site where the undersea tunnel will start from Vikhroli to Thane. That's a very, very challenging project. The project is now progressing very well. Okay. The shaft is getting built right now, as we saw in the morning today. And in the BKC station, again, the progress is very good. This is again a very complex project. This is like 10-story building below the surface and 30-story building above the surface. So that is the complexity of this project. And I'm very happy to see that the railway engineers are today working with a new level of confidence. This is exactly Prime Minister Shri Narendra Modi ji's vision is. His point is that this project should actually give us new technology. We should be able to learn new ways of working. That is quite visible today. So very happy to see the progress.
Okay, flagging at some more stocks which are making life high levels. Geo Fintech is up around 7%, sitting at life highs. Astral up 6%, life high level. NCC, Bharat Electronics, Indian Hotel, Lemon Tree, these are the names which are sitting at record highs. Nuresh, what's your take on Geo Fintech? What do the charts suggest in terms of the next level to watch out for?
So not a lot of history, but the trend is positive. Says the last few days it made a top around this 695, 700 level. So a fresh breakout. The last range was say roughly 100 points. So expectation would be a target price of 780 to 800 and a stop loss below 700 now.
Mahantesh, what about industrials as a pack? ABB, since its earning, had set fire amongst the entire sector because that stock was up almost 20-25% post its earnings, and rest of the names, the Cummins, Siemens of the world, even Thermax, etc., they were all sitting at record high levels. But today there was a note coming in from Axis Capital saying that the reaction is overdone. There wasn't a big change in the commentary last quarter to this quarter, and that's why they have downgraded ABB. Which side of the debate do you sit on? Whether you recommend the investors to buy it right now or stay away?
So, many of these names are at the forefront of technology, and we have seen that for quite some time, the power sector, which is both on the generation side as well as on the distribution side, has been a laggard because we haven't seen great growth in terms of overall power consumption per se. But with rapid technology coming in, particularly on the renewable side, there are more solutions that need to be offered for customers, and some of these companies are at the forefront of offering those kind of solutions. You have IoTs coming in the power generation as well as distribution space. You have smart metering coming in, and you have even power generation capacity per se on the traditional coal side is likely to come up. These trends tell us that there are exciting times ahead for the sector, and therefore the technology leaders, which typically is led by the MNCs in India, would start taking the first step ahead and will have the first mover advantage. I would rather sit on the debate that says for a really long-term investor, these are companies that should not be let go of easily. They are not either trading stocks nor are they stocks which you should avoid. having in your portfolio. They are kind of must have, at least now where the sector is started looking up. So I would really sit on the positive side of the debate and look to grab these stocks whenever they fall cheap.
But good to have you on the show as always, Mahantesh. Kunal Naresh will let you go.